Hello, this is Doug Gerlach from iClub Central. Welcome to our Lunchtime Stock Club webinar. Today is Monday, February 8th, 2016. Glad you could join us today. Here in New England, it's a snow day for many of our local schools. We're getting another snowstorm, but after having missed the brunt of the mid-Atlantic snowstorm that hit us a couple weeks ago, we're fine with a little bit of precipitation this weekend. But I hope you're staying warm, and I hope you're taking, or rather searching out for reassurance with the market's current activities today. But we'll talk about that a little bit later, and hopefully we can all console each other and look to the future for perhaps some better times. As usual, if you're having technical problems of any kind, please contact gotowebinar.com directly from the control panel here at iClub Central HQ. It appears that the audio and video and the webinar is working just fine. So if you're having problems, chances are it's with your particular computer or your internet connection. So contact GoToWebinar and they can help you diagnose any kinds of problems. Some things you can try, of course, if you are having problems, if the sound or graphics are choppy, turn off any unnecessary programs that might be running on your computer, especially those that are residing in your system tray. Make sure that you're not using Wi-Fi if you can help it, and you can always listen using the telephone, which will free up bandwidth for the webinar connection. If you do have a question at any point during our presentation, please go ahead and use that questions box. I'll be monitoring that throughout the presentation as well as at the end. And also check out the handout, which should be available there in the handouts tab, the PDF of the presentation today. So it should be there. It's dated 2016-02 lunchtime learning.pdf. You can click on that. It'll open or save on your computer, and you can refer to it later. You can print it quickly right now if you need to, and then you'll have that reference point for referring to later on. We'll provide the handout when we archive the webinar as well. And speaking of archives, you can find out more on iClub.com about our upcoming webinar schedule, as well as get the links to the video viewing on demand webinars that are published there. A few notes: our next Lunchtime Stock Club webinar will be on March 14th, the same time, 1:30 p.m. Eastern Time, on Monday, March 14th. There is no toolkit webinar in March, but we will be back in April. And next week, here at iClub Central, we'll be producing our Investment Club webinar. It's our walk-in tax clinic webinar. So that'll be at 9 p.m. Eastern Time on Tuesday, February 16th, 2016. That's when club treasurers can bring their questions, their problems. Our team will be on hand to try to answer those during the presentation. If multiple clubs are having the same issue, it's a good resource. We can demonstrate online how to do things so that everyone can see. So that is Tuesday, February 16th. Make sure that your club treasurer is aware of that particular performance. Finally, you can like us on Facebook for updates. We'll publish when videos are released for viewing on demand, the archived webinars, as well as other information about all that we've got going on at iClub Central. So let's take a look at where we are now, just about 5 weeks into the new year, and what a year it's been. Here's the market performance year to date with our 3 tracked market segments. The top line in blue is the S&P 500, which as of earlier, mid-morning today was down 9.75% for the year. I think it's dropped a little bit more since then. The red line is the Russell 2000, which is down 15% for the year, and the green line is the Morgan Stanley Europe Far East Australasia Index, the international large cap index that we track, which is also down 10.3% for the year to date. Of course, this is just the year to date figure. The S&P 500 is actually down more than 10% from its highs in mid-2015. The Russell 2000 is down more than 20%. So we'll talk more about that. markets had seen a little bit of drop earlier on. The last couple of weeks have been pretty steady, but today, especially, we're seeing some market response to corporate earnings and the increased volatility driving things down just a little bit more. Here we are with the S&P 500 PE ratio, 20.34. Last month when we met, the PE ratio of the overall market was 20.24. So the PE ratio has actually gone up a little bit. You can see the red line, which indicates the current PE ratio as it relates to the market in its history going back to the 1870s for the large cap segment of the market. So 20 is rather elevated, but not for the last couple of decades. It's actually been higher than that on a number of occasions, driven by market forces up and down. Actually, in the couple of years ago, 2000 and earlier on 2011, 2012, the PE ratio was below 15. As evidenced on this chart, and it's been steadily driving up. That's fueled by corporate growth, corporate earnings. We also like to look at the S&P 500 earnings per share, which stand at 90.12. And again, this is actually down. Earnings for the S&P 500 on a trailing 12-month basis now are down to have fallen to 90.12. They were 94.39 when we met in January. Not completely unexpected. A lot of analysts were looking at 4 to 7% growth for S&P 500 companies. Of course, the energy stocks continue to drag down earnings as they report losses. Companies like ExxonMobil having a lot of problem with the lower oil prices and maintaining profitability at consistent levels as they had in the past. So not quite surprised to see that earnings dropping. And again, this has somewhat been propping up the market, the fact that we've been expecting earnings to come in a little bit worse this year, a little bit low. A lot of companies reporting negative earnings in the S&P 500. A lot of companies coming in with figures that are a little bit below where they had been in the last 12 months, in the last fiscal year. But that's certainly the fact that earnings are dropping and yet the P ratio is going up indicates that investors, I think, are adjusting to the volatility and adjusting to the lower expectations. In fact, if we look at kind of wrap it all together, where are we now in the market? Well, the S&P 500 is in correction. It's down more than 10%. Since the highs that it reached last year. In a correction, that's by definition a market correction. So we are in correction mode. The Russell 2000, however, is in bear market mode because it is down more than 20% from its all-time highs, and that puts it into bear market mode for the small cap segment of the market. As I mentioned, large cap corporate earnings are being reported right now, so all eyes are on corporate earnings, and expectations are pretty low, which is why all that unexpectedness is priced into the market right now. Oil outlook still uncertain, with oil in the 20s per barrel. A kind of unprecedented event. I saw a pundit who was quoted, the CEO of one of the major oil producers, when oil was $100 a barrel. He was quoted as saying, "A $100 barrel of oil is the new normal. We're only going up from here." And here we are at less than a third of that price, which just goes to show you that anytime someone says this time it's different, they're generally wrong. Now, one positive sign is that investor sentiment is very bearish. Investors are looking ahead and they're saying, yep, things are really terrible, and they're taking action. Well, when investors reach that point, it's generally late in the game, and that's a bullish indicator over the next 12 months. So as investors become increasingly negative, it means that the bottom is coming. Now, of course, we can't judge when or where that bottom will come, but it is kind of interesting from an investor psychology perspective that many individual investors are, and many analysts, many brokers are looking at the market now with a negative view, and that actually is a contrarian indicator. Most analysts aren't looking for a quick recovery. You'll see a lot of people being quoted today saying, "Yep, this is what we expected. This is what we've been saying all along." Whether or not they've been saying it or not is irrelevant. But there are definitely low expectations, and the upside of low expectations is that it doesn't take very much to get people reassured, although it could be a long time in coming. But of course, we are not buying the market, we're buying individual companies, so we can continue to look at those good companies and buy them at reasonable prices, buy them at sale prices, buy them at points that provide maximum opportunities for us over the long term. Let me go, I'm gonna flip over to Yahoo Finance and just do a quick see where we are. Yeah, the S&P 500 as of today is down just about 2.4%. The Dow's down 2.2%. The NASDAQ down 3%. So still in sell-off mode today. We might see a little recovery by the end of the day. Crude oil at $29.97 a barrel. So yeah, this is, and gold up 3.5%. So investors moving towards gold, moving towards the sidelines, and the 10-year bond down 5%. So quite a day in the market today. But we're going to continue to do what we do, which is look for individual opportunities in the market. And today, I found some words of wisdom that I thought I would share with you about bear market investing. This is Shelby Cullum Davis, who said, "You make most of your money in a bear market, you just don't realize it at the time." Bear markets are highly emotional for individual investors. It's a tough time to be an individual investor, to be a long-term investor in the market. But Shelby Cullum Davis was actually one of the greatest investors. He turned $100,000 that he started with in the 1940s into $600 million by 2004, the time of his death. And he did that primarily by investing in insurance stocks, which are not known to be enormous growth opportunities, although Berkshire Hathaway certainly provided a big chunk of that. But his compound annual growth rate over 47 years was 23.2% as an investor. And it's not actually that common that we see wealth being built by someone investing in other businesses and not just being an entrepreneur. So Shelby Davis really knew something. His successor company, his son is still running it today. But it's an interesting perspective to remember that bear markets are where long-term investors can really build wealth. And that seems the opposite of our perception of bear markets. But even if you go back to the NAIC manuals from the 70s and the 80s, you'll find these little tidbits in there where, or a description of the Mutual Investment Club of Detroit and how during the worst times, during wars, during recessions, periods of slow economic growth, periods of terrible bear markets, they continued to meet, they continued to invest their $10 a month or $20 a month, and then all of a sudden they look back from the height of the bull market and say, how do we do so well? It's because they weren't paying attention to where they were in the market cycle. They were investing for now with the best opportunities that they could find at any point in time. And I think Shelby Davis's quote here reinforces that idea that if we paid a little less attention to where we are in the market and a little more attention to the individual companies that we have and maximizing the opportunities that are presented to us, we can profit in the market during the bear cycle when it arrives, or even during a sideways market like we are in and have been in for some time now. So bear markets can make you a millionaire if you stick to your principles and have that long-term focus. And speaking of long-term focus, last month we did update you on the investor advisory service, which has been around since 40 years. For almost 45 years now, been publishing, recommending 3 stocks a month to subscribers during all sorts of up and down and sideways market cycles. As of the end of December 2015, the Holbert Financial Digest has now been tracking the investor advisory service for 20 years, and we are actually, I think we're the 6th or 7th best newsletter for 20-year performance since 1995 through 2015. And so it feels pretty good to be recognized that way. We've been on the honor roll, which measures a different type of performance during up and down markets. But when you look at our track record over 10 years, over 15 years, over 20 years, we're generating some significant performance relative to the overall market. And this just compounds and adds up over time if you look at the types of stocks that we're investing in. So again, just more validation for us that we're this approach to long-term buy and hold, bottom-up investing does have and remains a strong contender for one of the best ways that individual investors can invest in the stock market. So we're very pleased about that long-term performance gains there. Now let's talk about our small cap informer. And we have a new feature that we rolled out last month. So if you are a subscriber, we didn't actually include the news of it in the issue. It came, but we got the programming on the website done after the issue went out. I didn't want to risk announcing something before it was fully programmed. But we have a new feature for subscribers. If you are a subscriber, we have now, when you log in and view each issue, you have the option to download an Excel spreadsheet that has all the data from the stock data table that we publish in each issue. So all of the covered stocks, the total return, the PE ratio, the current price, our earnings per share growth projection, the risk reward ratio. All those data values are now in that Excel spreadsheet. And what's useful about that is that you can download that Excel spreadsheet and you can sort by any column. So you can sort by the total return column, the projected total return column, or sort by the PE ratio column to find the lowest PE ratios. You can add your own formulas. You can calculate the PEG ratio if you're into that, and you can bring that in. So there are all sorts of options that you can do with that spreadsheet. Here is, if you log in and go to an issue like the January 2016 issue that I have logged into here, you'll notice this stock data table link with the XLS file extension there, which indicates that this is an Excel spreadsheet that you can download. It's we produce it. I think it's the Excel version, essentially the version 6 or higher, if I recall, or the Excel 97 or higher, to provide some backwards compatibility. But you can open it in OpenOffice or Google Docs. It'll work just as well. If you click on that link, you'll get the spreadsheet like that. So we're covering about 52 stocks currently in the small cap informer. We've got, out of that number, 6 or 7 or so that we have re-recommended, as we do with the investor advisory service. Sometimes we find the most compelling opportunities or stocks that we have already recommended, but we just re-recommend them, re-review them. So we've got 6 or 7 companies. So that's actually pretty good for our 3.5 year history, the number of companies that we've got that are actively being covered, compared to the number that we've discontinued or recommended for sale. So here you can see all the components on that Excel spreadsheet: the industry, the price, the current PE, projected earnings growth, the maximum buy price, the sell above price, total return, reward to risk, and then the issue that it's in. So you can go back and find the original write-up if you want to review those past issues. So for those of you who are subscribing to the Small Cap Informer, and that subscriber base is growing, for which we thank you. You'll be able to find that right now for the most recent issue if you didn't see it when you were logging in on the website. Al asks about the Small Cap Informer. Do you need to subscribe to IS or does it come with the iClub service? The Small Cap Informer and the Investor Advisory Service are two separate newsletters. Each have to be subscribed to separately. They're optional. They are for people who are looking for additional opportunities and recommendations for investing in their personal or their club portfolio. So those are just part of the suite of tools that we provide to help you as individual investors to identify stocks. The Investor Advisory Service covers all sizes, small, mid, and large cap stocks. The Small Cap Informer covers the smaller end of the spectrum. Some of them creep up into what might be considered mid-cap stocks or mid-sized companies, but the focus is really on the smaller end of the spectrum. The IS, we recommend 3 stocks a month. The Small Cap Informer, we recommend 2 of these smaller companies on a monthly basis. When you look at our picks right now, we have a lot of stocks with higher projected total returns simply because the price has been knocked down on a lot of the small cap companies, which I think creates a lot of bargains, a lot of opportunities for you to take a look at. You can find information on all of these products that we make at iclub.com. So I recommend that you go there, check it out, or you can email me if you have any questions. And I can actually, if you email me, I can send you a promo code that will help you subscribe at a discount, get you a pretty nice discount on those 2 newsletters. So feel free to do that. I'll ask, do you still use the measure market cap by revenue? Well, we measure company size by revenue, and we are in the process of bumping up our definition of what makes a small and a mid-sized and a large company when looking at trailing 12-month revenues. So presently, we're looking for companies that have revenues below $1 billion as a small company or below $10 billion as a mid-sized company. So those values have been bumped up a little bit from where they were previously. Now, at our Investor Advisory Service, we do have a market cap label that is used in the spreadsheets that you download from IES, and it's labeled market cap. So we have, we can look by market cap or we can look by revenues, and there might be different times that you would consider the different types of measurements of company size. The Better Investing approach traditionally has looked at the size of company by revenues, just allowing you to strip out the investor sentiment aspect of market cap, whereby a small company that's very popular with investors will have a high market cap, but it really won't be a big company. So when you look at revenues, we're measuring companies against each other and helping to identify the size just purely based on the fundamentals, and that's the rationale there. So what am I reading these days? Well, I'm starting a new book that was just published. It's called Juggling with Knives: Smart Investing in the Coming Age of Volatility by Jim Jubak. And Jim Jubak has been covering the markets for a long time. He was a senior financial editor at Worth magazine in the 1990s. Then he was senior markets editor at MSN Money for a long time. Now he writes for Yahoo Finance. He was also a market, an analyst and editor for The Money Show, would speak and would comment on the market at The Money Show and in their media. He has a website at jubakpicks.com. You can visit that. He does a nice email wrap-up that you can subscribe to for free on his website. His approach is as a long-term investor. His specific methodology differs a little bit from ours, but there are a lot of similar elements. And so he's one of those pundits that I've often found myself in agreement with. Think he articulates things very well. So his new book, I think, is really timely, and it's something that I've been interested in for a long time, which is this increased volatility in the markets, and how does that impact what we do as long-term investors. So hearing from someone who is a long-term investor like Jim Jubak and who's done the research and done the study, I think is really interesting for a lot of reasons. In the book, there are 3 parts here. One is about the volatility that's going to be coming on an increasing level for the years and decades ahead. And part 2 describes how this volatility affects everything about everyday life, not just about the markets. So that's an interesting perspective, and I'll talk about that. And then finally, he provides some solutions for dealing with volatility as individual investors. One of his points is that there's heightened volatility that's embedded in the market. It doesn't take anyone a genius to acknowledge that since 2000, we've had frequent zigzags in the financial markets. We've had bear markets, we've had sideways markets, we've had recessions in the economy and expansions in the economy. And he points to these events in the housing, the job, and the retirement of markets, and how they are affecting our expectations about volatility in everyday life and how that affects our decision making. He talks about things like how the world is getting much older than it's ever been. Medical science is now prolonging lifespans, and that's changing a lot of things as a ripple effect. And one of the interesting things that you probably have never thought of, but China, with the world's largest population, also has the world's fastest aging society. You remember, a primarily agrarian society has a lot of rural citizens, has very low accessibility to healthcare, and that is changing so rapidly that China is now growing. It's the oldest part of its society much faster than anywhere else on Earth. Well, that is going to create a lot of demands on pensions and healthcare in the future. And what China is doing in those areas is not keeping pace with the aging of its society. And Jubak says this is going to generate a lot more global volatility risk just coming from the demands of this segment of the society in the largest population center in the world. But there are some other major concerns that he points to. For instance, the consequences of global central banks operating as cash machines. So monetary policy is not keeping up to date with volatility. Financial systems that will not be reformed. We see that in the U.S., where reforms have been rolled back. And that has created situations that fed into, if not directly caused, the financial markets meltdown of 2008. We see China, as we mentioned, what he calls the world's largest game of 3-card Monte. And around the world, we have these aging populations and the war, the battles between the young and the old. Young people who don't want to pay into Social Security because they don't believe it's going to be around. They want to cut it, they want to extend it, and increasingly older segment in the U.S. that wants to preserve those benefits and sees them as a right rather than as a safety net as they were originally declined. So that's going to continue to create a lot of conflict. And then finally, he points to a lot of the environmental externalities, climate change and energy uncertainty, which are going to have a bill coming forward. Every time we see radioactive water seeping into the water base, we see lead, we see water shortages, we see climate change. We see increasingly catastrophic weather patterns. All of these have a cost associated with them. And how are we as a culture, as a society, as a country going to absorb them all? And he points to this as one of his major concerns about the financial markets, how they're going to be impacted by these types of situations. So, of course, he's going to provide some solutions. Wants to address the issue of how we limit the downside damage and increase the upside potential from this volatility in our portfolios and our lives. And he asked the question, is it possible to find what he calls a, quote, haven of lower volatility by determining the distribution of volatility in a given market? And I won't give away all of his solutions, but he does say that individual investors should resist the impulse to engage in flight or fight response in reacting to the dizzying changes in the market. The zigzagging sideways, up and down nature can drive us to behavior that's not profitable. And so we need to be aware of that and take action accordingly. There are, as Jubak points out, very many advantages of long-term investing, that having that long-term horizon gives advantages to individual investors in volatile markets. We can buy terrific companies at reasonable prices when they're out of favor, and that's something that you've heard me say many times before. He also says you can pick up an entire sector or trend when most investors hate it. I often look back at 2008 and said, gosh, at the bottom, or even not at the bottom, but as the housing market was bottoming out, and as real estate related stocks and financial stocks were bottoming out, you could have bought real estate investment trusts in 2008 or 2009 that 5 years later would have delivered a phenomenal rate of return when the housing market and the real estate market did recover. If you wanted to be contrarian, maybe now is the time to buy energy stocks when they have been beaten down so badly. Will they continue to be beaten down? Well, we don't know, but that's part of the contrarian nature of long-term investors, gives us the opportunity. Now, he says we don't have to become traders, but maybe there are times when we sell at market tops, when we sell at sector or trend tops and buy at sector or trend bottoms, and still be true to our long-term focus, but just take advantage of the opportunity that volatility drives in the marketplace. When we look at our individual stock portfolios, we look at individual equities, and they're at points where we consider them overvalued. In the Better Investing and Toolkit approach, we do suggest considering replacing those stocks. They have the potential to deliver lower projected returns, and that higher than usual PE ratio range means that during a correction or a bear market, or even a company downturn or a sector downturn or an industry downturn, that company is going to get hammered, and we're going to see losses from the current valuation. So there is a little simpatico benefit that we see, as I think Jubak does, from his advantages of long-term investing. Lynn Hansen suggests look at geoengineeringwatch.org and click on targeting California for more on the weather. So I'll go ahead and flip over to that. We are, I have one little add-on that I'll bring in a minute. So let's go over geoengineeringwatch.org. And then, so all sorts of geoengineering things. Click on targeting California. So I don't know if that's an article or if we can find it easily here. But there's certainly a lot of engineered droughts, global meltdown, coming collapse, global flashpoints, etc. So here's a website that you can take a look at for So for some more, we won't. I won't click around on here, but one of our viewers have suggested this, so go ahead and take a look at that if you're looking at weather patterns and climate change information and how that might impact the markets and our economy. I wanted to talk about copy.com. This is the cloud-based synchronization service that I started using as a replacement for Dropbox. I just didn't feel very comfortable with Dropbox's policies, with its privacy policies, and backdoor encryption kind of opportunities that they were welcoming, it seemed. So I went off in search of other solutions for synchronization. I tested several. Several failed, like Microsoft OneDrive, just did not work as a synchronized tool. It might work as a backup tool. There were a couple of others that I tried, but I found copy.com, which was made by networking equipment company Barracuda, and it worked terrifically. It synced well. I was very pleased with it, it was the price was right. It was free for a pretty significant amount of data. And they've discontinued it. It'll be ending in May, so I'm testing other solutions. So I welcome suggestions. Just if you're not aware, this is a way, if you're running Toolkit on your desktop and your laptop, you can move the library using the Toolkit's library tool. You can move your library into a different location than the default. And so I would move it into my cloud-based synchronization folder, my copy.com folder, and then when I made changes on my desktop, the next time I would go to my laptop and open it up and be connected to the internet, my library would exist in both places. Now, you can't use them at the same time because of synchronization errors, so it really only works in this sort of home and office, or home and laptop, or home office laptop, where you're only using one computer at a time, one instance of Toolkit at a time, but you would have access to all of your stocks and your current studies that way. So, and if you have questions, I have generated instructions for how to set this up with your Toolkit. So anyway, I'm testing replacements right now. I found Yandex Disk, and Yandex is one of the stocks that we've been covering for a long time in the small cap informer. It's been hammered it was doing quite well. It's been hammered with the international situation and what's been happening in Russia. It is a Russian company, although it's headquartered outside of Russia. They just do operations, they do business in Russia, but they're actually located outside of Russia in their corporate headquarters, their corporate base. But they make a cloud-based synchronization tool called Yandex Disk, and I've installed it. I disabled some of it. It wants to upload all of my pictures, and I'm not interested in sharing all of my photos or having them in a cloud-based solution. So I disabled some of the features, but otherwise the synchronization has been working really well, which means it's updating on a regular basis. It's not getting stuck, and they have an interesting feature, a new feature that is a screen capture tool. So when you press the print screen or the Alt print screen on your computer, instead of just copying to the clipboard, it opens this Yandex screen capture application where you can crop and make notes. And that's actually been pretty useful as well. I was kind of surprised to see it, but it worked out. You can disable that if you want. That's my best pick so far. If you have a cloud-based synchronization program that you think works or that you're using on your computers, feel free to let me know. I'm happy to kind of test it out. These are different from backup programs. A backup program may not work as a tool to synchronize multiple computers. And we're not synchronizing everything. I have a single folder that's my cloud-based synchronization folder, and I put my active documents there so that when I'm on the road with my laptop, the stuff that I'm working on right now, I can access, and then I'll archive things back on my desktop, and then it gets, I have a backup, a cloud-based backup that backs everything up. So I have some redundancy. I can find things if I need to. But this is just another way of, a simple way of kind of having an active use folder that I can move files around on from desktop to laptop without using a flash drive and have access when I'm on the road. So that is my pick here. Okay, Dick points out Wikipedia describes the on-deck service, so you can check that out there. And Lynn says that targeting California is a 57-minute video about weather at California, weather and climate change in California with the drought and what the impact of that is might be as you go forward. Okay, at this point, we'll take a look at any stocks. If you have any stocks that you want us to take a look at, feel free to let me know. We have our small cap informer came out the last couple of weeks. We have a lot of stocks that we've been covering in the small cap informer that are ripe for review and reconsideration. And I talk about this in the issue in my commentary that when you rank stocks by total return, projected total return, so you can do this in your toolkit. Let me flip over to toolkit and we'll take a look. Here's my sample. This is a sample portfolio, so it's sort of a test portfolio of not necessarily relevant data. But go to the overview screen for your portfolio and click on the total return column and sort by highest total return to lowest total return. And often what you find is that these stocks that have very high total return are stocks that have been beaten down in price. So they may have lower PE ratios than expected. They may have had stumbled in their earnings. They may have had more than just the impact of an overall price decline. If we talk about the S&P 500 down today something like 13% from its high, you would assume that companies in the S&P 500 that had declined more than 13%. Investors are more negative on. If they've declined less than 13%, investors are less negative on. If they declined about 13%, that could just be the market talking and saying, well, people are pulling cash out of the market. When that happens, they pull it out of all stocks, all index funds, all ETFs, and so it kind of comes out across the spectrum of the entire market, with some outliers on either end. And what I've just described is more or less a traditional bell curve, where you see on the left side, you see the stocks with the low expectations. On the right side, you see the stocks with the high expectations, and in the middle, you see a peak of stocks that have reasonable groupings kind of around the middle of their expected ranges of total return. And that's where the bulk of it is. And we tend to stay away from the extremes. So the companies that have the most extreme total returns on the high side are often companies that we might want to avoid. So here we have, I'll go ahead and update portfolio prices just to see where we stand as of today on some of these total returns. And you can see here we have in this study of T. Rowe Price, and again, this is just a sample study, but the reward to risk ratio is 99.9 to 1. 99.9 to 1 means that the current price is less than the projected low price. So in this case, the current price is 68 and our projected low price is 71. So this stock is a stock that is valued lower than we expected it to when we created the stock study. And so the remedy is to adjust our downside expectations. This is T. Rowe Price. So of course, during a bear market, they tend to underperform. So if investors are looking to see a bear market, they're going to value this particular company lower in the future than they have in the past. The current PE ratio is 15. The average PE ratio is 19. In the last 52 weeks, the PE ratio has ranged between 14 and 18. So 15 is at the low end of the range. And T. Rowe Price makes a lot of actively managed and equity and passively managed equity mutual funds. So if investors are pulling money out of the market, they're going to pull them out of those products. Maybe they won't pull their assets out of T. Rowe, but they'll put them into asset classes that make less money. Actively managed funds make a lot of money. Money sitting in cash doesn't make a lot of money for T. Rowe. So if investors are pulling out and going into bonds or bond funds, those don't make as much money as investors in equity funds. So we would expect their earnings to take a hit a little bit. So we would need to adjust for that. But that's at that bottom end. Projected total return is in excess of 20%. It's not until we get into a more reasonable total return range, somewhere in the 15 to 18 to 20%, that we see kind of the sweet spot of stocks that might present the best opportunities right now. I'll switch over to another portfolio, and again, we want to update our prices, update our data when we take a look at these. But you can see in this case, there are a lot of stocks that have that same situation where the current price is lower than the projected low price. We would want to revisit those, but you'll see total return 53%, 41%, 35%, 30%, just excessively high total return expectations, and so we want to review those as we go ahead. We also need to update portfolio data for this old portfolio, which I'll do really quickly. So now, again, we still see the same situation of high total return, and some of these stock studies that we need to revisit because the current prices are well below. Now, there are some investors, some people who use Toolkit and have used it for a long time, who say, well, that's okay. If your projected low price is higher than your current price right now, that's not unreasonable for some companies. And if we were in a correction or a bear market, it may be the case that in the next 5 years, the stock will never be as low as it is today. But that is sort of an expert mode of using the program. Joe asks about Apple, any concerns about the future growth of Apple? And certainly it's been big in the minds of many investors. The thing about Apple is we look at it here, we have first quarter results for the quarter ended December 31st, and sales only up 1.7%, earnings up 7.1% as reported here. And I think I'm gonna kind of just resize this to emphasize this break point that we have, this kind of inflection year here in 2012, right? So we have everything that happened up to 2012 and what the company's done since 2012. And you can really see that the growth from 2006 to 2012 was on a different trajectory. And then after 2012, the growth of sales and earnings really kind of slowed down, even flattened out, even declined a little bit going forward. Apple was recently overtaken as the largest company by market cap, but sales $233 billion. And I think what you need to be careful of at this point is that the historical sales growth, as reflected here on the stock study, if you come down to the bottom here, you see the historical sales growth is 34%. The historical earnings growth for the full 10-year period is 46.1%. And those are definitely very high values. Even in this stock study, the projected growth is 15%. I think that's pretty high. But here's what you need to look at. Here in Toolkit, you need to, I'll maximize this, click on the historical growth button, which is right up here, the historical growth button. Click on that on the visual analysis toolbar, and you'll pop open another window that looks like this, that shows you the rate of change of the growth of sales and earnings by multiple year periods over the last 10 years. And this is really showing us, as you look on the, you can really see that slowdown as we get into, that last 2012, 2013, 2014. So really, this is the same point on the graph that I articulated on the big graph. This is the same period. So here we have 2012 to 13, 13 to 14, 14 to 15, where you see the growth kind of reaccelerating a little bit because it's coming from zero. I mean, it's coming from kind of nothing. But we see here 12% growth of sales and earnings. It's really 13% over the last 3 years. And then we've seen this little bit of recovery. But as you see on the front, on the graph, I think that you need to start being careful about the growth rate that you're expecting. And the market is also being very careful. The market has really dropped down the valuation of Apple on a P ratio basis because of the feeling of an impending decline or continuing decline in the growth rate. But a 13% growth rate from 2012 to 2015. So this is hard to kind of evaluate it on here, but this is about a 13% annualized growth rate of sales and earnings for that period. It's partly here we are very compressed, so it doesn't look like 13% because we've added as many scales as we can in the program to accommodate the growth rate from 2006 to 2012. So hopefully that makes a little sense. Let me flip over to the back and we'll just look at the P ratios because we'll learn more a little there. In the last 52 weeks, the P ratio of Apple has ranged from 9.9 to 14, and it's currently trading at a PE ratio of 10. And I think that even 14 may be high for Apple going forward. And the 5-year average high PE is 15.8. Just kind of where I'm looking here. Here's the 52-week high P ratio 14. Here's the 5-year average high P ratio 15.8. Here's the current P ratio 10. It's also down here, current P ratio of 10. And then you can see in this analysis down here, the P ratios have been very high. They're knocked down on the low side, down to 8.8. Which brought the price down to a low level. I'm going to go ahead and kind of update what I'm thinking. And, again, I think that growth is likely to be in the 10 to 15% range. Just it's the law of large numbers. This is a very big company. They've saturated the developed market with their devices, at least on the iPhone, and the iPad side. On the phone, they're getting a lot of competition from Samsung, and the problem is that once you go outside the developed world, there might be opportunities to expand their presence, but the margins are going to be much lower. And Apple's margins have been very high. They're selling for the most part, quality product at a high price with high margins, and you can't get that high price outside of the developed world quite as readily. And I think that's going to be a big part of it. I'm not convinced that the Apple Watch is going to expand their market, and I don't know where they're next. Certainly, the Apple TV has not expanded, or changed the market the way the iPhone and the iPod and the iPad have all done. But at some point, if they don't keep innovating and finding what that next great product is, then that's going to be a further drag on their growth. So anyway, assuming, let's say for sake of argument that we use a 12 PE or 12% growth rate. In most cases, I wouldn't for a company that's growing at 12%, I would cap out my high PE at 18. But Apple's not even traded at a PE of 18 in the last 5 years. The highest they've been is 17. And I think that PE contraction, I don't see any sign that that's probably going to continue. So I might say a PE of 8 on the high side of 14 and on the low side of 8, looking at the 10-year history here. They have been as low as 8 in 2012, up then upwards. They've had some more support up as high as 10. But let's say that the PE of 8 on the low side, that once it gets down that low, they are starting to pay a dividend. So now the price the dividend supports becomes more useful to us. So down here for the low earnings per share, well, we got to go back and change up our earnings expectation to be closer to 12%. So I'll do that from the preferred procedure screen here. And it looks like that oops, meant to change this to leave the margins the same, the taxes the same. They've been issuing a lot more shares out. Oh, the shares they've been buying back shares. All right, so we'll leave the shares here. That gives you 13% earnings growth. If they grow sales at 12%, they maintain margins at 31%. That's where the stretch is, because they haven't been that high. That's kind of an all-time high. And as we said, we kind of expect them to be have some pressure on the margins, but that gives you 12% growth. All right, so that's a high price of 227 at a PE of 14, $227 from $94 right now, which is not too bad. On the low side, if we see trailing 12 months of earnings of 942, that's a low price of 75 from the current price. And as I mentioned, the price the dividend supports, this essentially says that when the price gets down to $70, the percentage high yield or the yield at that point will be high enough that income investors will be attracted to this stock, that individual investors won't sell it because they'll be happy to collect the yield at that level. So I think somewhere between 75 and 70 is really a valid place to be thinking about for the projected low price. And the 80% is also at 75. So I think that's a pretty solid assumption for a low price, would be 75, a price of $75. If it gets to 75 or much below, there will be a floor there that the dividend investors will pick up on. So again, the real question is this 14 PE. Will these PEs continue to contract below 14? They've been very stable at that 15% range with growth of that's averaged 13%. So 14, seems to be maybe a little aggressive, but that puts it at a buy. Let me just pop in the yield here. They've got a payout now, so there's a little bit of yield. So it doesn't look like, again, it looks like not a bad opportunity at the current price. The big questions are, what's that growth likely to be? Company is definitely changing. Is 12% too aggressive? Maybe try 10%. And that high PE, is that high PE going to continue to deteriorate? It's been going down consistently, or do you think it's going to stabilize or remain stable as it's been? It's been, it's been shifting moderately lower. I mean, 15, 16, 17, 16, 14, it kind of goes up, goes down, but what's that likely to be going forward? How conservative do you want to be? And I think the low side, we're pretty protected at certainly at $70 or at $75, you'll have people buying. Again, this is not based, assumes that the company will be kind of fundamentally stable, that they're not going to have a blowout where they got to recall all of their iPhones because of some manufacturing problem or something like that. But this assumption is just that it continues to chug along, continues to make products that do reasonably well, if not exceptionally well. They continue to expand market share. They continue to innovate. All of those assumptions, and that's where your research will help inform your decisions there. Okay, oops. We'll take a look a couple more real quick. AWK, Tamara asks about this particular stock. American Waterworks. I'll go ahead and show Toolkit's judgment. This company's been presenting at Better Investing conferences. You can see, let's get rid of these lost years and we'll focus on the period from 2010 going forward. Sales growing at 3%, which is typical in a regulated utility environment. I mean, their job as providing water doesn't give them, primarily on the East Coast and the Midwest, doesn't give them a lot of opportunities to raise prices. They have to go through regulatory utility commissions in order to do that. But they can, one of the ways they can increase prices is by investing in infrastructure. And that's one of the things that they've been doing. As I understand it, investing in upgrading their water mains, water pipes. When they do that, they can apply for a rate increase that would offset and allow them to earn a rate of return on those investments. They also acquire other smaller metropolitan or municipal waterworks and bring them in. So that's how during this period, on a 3% sales growth, they've been able to increase earnings 11%, which is pretty good for utility. On the last year ago quarter to quarter basis, we're waiting on year-end results. Sales grew about 6% and earnings were up 10%. So they're able to kind of continue that 10% growth rate. So I'm going to go ahead and plot in. I'm just going to plot in about 3.8% sales growth and 10.3%. We'll just continue the most recent quarterly growth rates. That 10% might be slightly aggressive, but that's what they've been able to do over the past. When you look on the back here, you'll see their profit margins have gone up. And that's how they're really leveraging their investment in order to maximize earnings per share. On the downside, the debt load, but this is a utility, so they need capital, so they do a lot of borrowing, they have bonds, et cetera. But that debt load has been coming down as a percentage of equity, so that's a fairly good sign, means their management is using their resources pretty well. And the return on equity is also increasing, just about 9%, which is pretty good for a utility. The P ratios, on the other hand, have been very expensive, getting up to 21, 23, which is a lot to pay for a company that's growing at 11% a year. Payout has been very consistent, about 50% of earnings, more or less, and the high yield has been falling as they've been generating a little bit of extra growth in the last few years that have provided capital appreciation. So what's the bottom line? Again, P's might be a little high at 19. I would say if we're using 10%, I think it's probably closer to 15 or 16 is a sustainable high, and on the low side, I think, gosh, they've been so high, but really, I would say maybe 12. When we look at the price the dividend will support for a company like this that's paying a dividend. This company doesn't really fit better investing principles quite so much. I mean, it's a solid, well-run. It is a growing company. It's a utility, though, and that always causes a little bit of problems here. So the price the dividend supports, which is 30, which is very close to the forecast low price of 31, and the average low price of 30.8 is the average low price of the last 5 years. Kind of not very relevant. But so I think that kind of gives us an indication that the price gets much below 30, reaches 30. That'll be a floor in. So at this point, then it really just shows up as a sale candidate. It's very close. Current price of 63, forecast high price of 68. So there's just not a lot of upside at this point, and potentially some downside. Again, I like the company. I was a customer of the company for a time in the early 2000s, and a company that they bought, a water company that they bought, so they've done pretty well. So again, do your own research and make your own assumptions though on this particular company. I'll have one more look. Tamer's gonna, okay. We'll take a look at CNC, Centene Healthcare Plan. You can see it's been a kind of, let's take out those out. Those are pretty good outliers there. Centene, CNC. So what we expect growth to be going forward. I'm gonna plot in 16% growth based on kind of where they've been in the last couple of years. Over the last decade, removing those outliers gives you sales growth of 27% and earnings growth of 15%. A lot of that is this more relevant period, maybe from 2010, where earnings were growing at 23%. Let me just put these back in, and we'll just go from here. Whoops. Again, just a kind of seat of the pants stock study. $16 billion in sales last year, $2 in earnings in the last fiscal year. Healthcare plans. Last quarter, sales were up 33%, earnings were up 11.9%. Margins very low, very low in the 2% range, but they've been kind of consistently in that 2 to 3% range. Had been as high as almost 6%, but that's 2005. So I really don't think that's very relevant. So 2012, I might take that out as an outlier as well. And then we have, you can kind of see a little bit below the trend, but it's so, the margins are so low, but kind of critical around that 3% range. So I'm not disturbed by a downtrend when the percentages are so small there. Yeah, some very high P ratios during their loss years. We'll take those out from consideration. So at 16% growth, the P ratio of the last few years, between 22 and 12. So I could work with that on 16% growth, a P of 22. And on the low side, P of 12, maybe a little lower. So that gives us, and I'll just stick with that forecast low price. So that gives us from the current price of 60, a high price of 130, low price of 36. So it puts it right squarely at the minimum upside downside, and compound annual return of 17%. No dividend to worry about. So fundamentally, just looking at the numbers, the valuation seems fair and reasonable right now. It's not necessarily cheap. It's a current PE of 21 compared to 17.6 on an average. But this is definitely a stock that I'd say, let's take a look at this and compare it, understand the margins, compare it to some other similar companies and see how they perform. But definitely one that is looking interesting. Dick says CNC is down 7.3% today. Let's update the price. So it's already 57, just puts it down. It was 60 as of the market close on Friday, so down to 57. So I want to know if maybe they've announced earnings for the fourth quarter, and that might affect things as well if they've had some glitches there. But the quarterly trends seem to be pretty strong. So definitely something to take a look at. Yeah. Diane says, are the rumors that Kohl's is looking to go private true? I don't follow Kohl's. It's in that sample portfolio, but I really don't find that yeah, so I have no news on that at all. Joyce asks, are there statistics to show who gets hurt most during bear markets in the long run, small, medium, or large companies? No, I'm not aware of any. I mean, the nature of a bear market is that it goes down 20%, and then it goes up 20%. So it goes down 20% from its high and then up 20% from its low. There's not a lot of correlation, or not as much as you would think, between small cap bear markets and large cap bear markets. Just because we're in a small cap bear market doesn't mean the large cap bear market is coming. I believe something like half the time that's the case. So it's not a very strong indicator that things are going to get worse for the large cap market. And in terms of size or length of the bear markets for small versus large, I don't know. I'll have to look at that a little more closely. Maybe we can talk about that in the future. Rita asks about Air Lease. Air Lease is a stock that we follow in the investor advisory service as well as in the small cap informer. I'm generally very optimistic about Air Lease. I think they have a great business model, great management team. I think they're really firing on all cylinders. I think that the global air market continues to grow at 5% a year. To some degree, lower fuel prices means less demand for new energy efficient planes, which Air Lease has been providing. But on the other hand, Air Lease's order book is full through, I think, through 2017 into 2018. So, on the one hand, we have a pretty strong understanding of what their earnings are going to be at a baseline over the next 2 years. And then on top of that, they have some additional initiatives, consulting, aircraft sales, management fees for partnerships that they set up to fund airplane leases that just are profitable for them. So I just think there's a lot of opportunity here. The growth, 16% is what I'm plotting. I think in our small cap newsletter, I think the investor advisory service is a little more aggressive, maybe closer to 18%, which is not an enormous difference. I like, but I'm looking at it from the focus of a small cap investor. Current PE is at 11. That is just, for a company that's growing at even 15% or 14% or 12% or 10% would still be a pretty reasonable, would be a really dirt cheap kind of PE ratio. I don't know that the P ratio is going to reach 23 again. I'll knock that down to 18, and let's say that our low PE is 11, which is where it's been in the last 52 weeks or so. That still gives us a low price of 24, which is right where it is right now, right? Because current PE 11, and we've knocked that high PE down to 18, which is a 52-week high PE. It's never had a high PE lower than 18 so far, and growth is still pretty robust, which would give you a high price of 52. So fundamentally, I think there's a couple of things happening. One is that investors don't know how to treat Air Lease. It's a transportation stock. No, it's a rentals and leasing stock. No, it's a financial stock. If it's a financial stock, it means that the P ratios are going to come down. But I still think there's a lot of growth there. And you can see that even if you knock these PE ratios down from 18 and 11 to even lower, you still have some phenomenal opportunities for growth going forward. They've started to pay a little dividend, so that's going to come out. You will see that they have a high debt load, but again, that's because they're borrowing money to buy the planes, and as long as the money they make on those airplane leases covers their cost of capital, that's what makes their business profitable. So the growing debt means they're growing the business. It not means they're financing new fuel purchases. What's happened to the company is that they had to pay very high interest rates when they started a few years ago. As they show that they did have a good track record, they were able to negotiate better rates from banks and other lenders, so they had actually cheaper access to capital. The interest rates going up is just not going to have a big impact on their business over the next few years. They would have to increase quite a bit in order for that to happen. And that's just not in the cards, I don't think, at this point. So all in all, I'm very optimistic about Air Lease and think that it's definitely a company you should take a look at right now. All right, well, we've really extended beyond our time. I will just point out that I will be at the Money Show in Orlando in March, and then back in Florida in April at the Southeast Florida chapter, out to Portland, Oregon in April 16th for their Investor Day, and then back to the East Coast to the Better Investing National Conference, which is in the Washington, D.C. area in May. So hopefully I will get to meet many of you at those events. Otherwise, thank you. There's my email address, gerlach@iclub.com. If you have comments or questions or suggestions for future webinars, I want to thank you all for coming out today. It's actually a pretty good turnout for our Stock Club webinar. Hopefully you've gotten some ideas that you can use in your personal club portfolios. Now's the time to really be focusing on replacing low quality stocks, because there's a lot of quality companies that are available at really attractive valuations. So think about upgrading your portfolio, using Toolkit, using the Better Investing tools to find maybe stocks that you already own that this presents a good opportunity to increase your positions in those. And then sit tight and remember that even if we do have a bear market, there's never been a bear market that's gone on forever. They always do end, and when they do end and the bull returns, the rising valuations will show up nicely in your portfolio balances. Thanks again. Stay warm, stay dry, and we'll see you next month.